All right, let's talk about recessions. I mean, just the word itself, recession, can make people feel a little uneasy, right? It affects so many parts of our lives, jobs, investments, you name it. So today we're going to try to break it all down. What exactly is recession? What are the signs? And how can understanding these things help us get through them? If you think about it generally, most people understand a recession as like a big drop in economic activity that lasts more than a few months. You probably heard the two-quarter rule, right? 2 straight quarters of decline in GDP. GDP, of course, being a country's gross domestic product, the total value of all goods and services produced. Now, while that two-quarter decline is a pretty good indicator, it's not the official way recessions are called. Here in the U.S., that job actually belongs to the National Bureau of Economic Research, or NBER. They're a private, nonprofit research group, and they get a little bit more complex definition. The NBER defines a recession as, I'm quoting here, but quote, a significant decline in economic activity spread across the economy, lasting more than a few months, normally visible in real GDP, real income, employment, industrial production, and wholesale retail sales. Okay, so let's unpack some of that. We've already talked about GDP, but the NBER specifically mentions real GDP. That word real is really important. It means the GDP number has been adjusted for inflation. So it gives us a clearer picture of what's actually happening with output, taking out the impact of rising prices. And, just to touch on inflation briefly, we usually measure it using something called the Consumer Price Index, or CPI. GDP growth is usually talked about annually, but is also calculated every quarter, every 3 months. Now, because economies naturally go up and down, they have periods of growth and the slower periods, the NBER doesn't just rely on these quarterly GDP figures. They're actually keeping an eye on 4 of the things every single month: personal income, the number of jobs, how much stuff is being made in manufacturing, and the volume of sales at the wholesale and retail levels. Looking at those things more often gives a better sense of where the economy is heading, in real time. So what actually causes a recession? What sets it all in motion? Our sources point to a few interconnected things. A big one is a drop in what's called real income. Now, this isn't just your salary. It's your income after you factor in inflation. And it also doesn't include government payments like, Social Security or welfare. Basically, it's how much your earnings can actually buy, excluding those safety nets. So when people's real income goes down, what do? Well, they often start spending less, which makes sense, right? And when consumers spend less, demand for goods and services across the whole economy weakens. You can see this weakening demand in another one of those key indicators: lower wholesale and retail sales. These numbers, get adjusted for inflation, basically show how businesses are reacting to what people are buying, or not buying, as the case may be. If consumers are tightening their belts, stores and wholesalers are going to see fewer sales. It's kind of a domino effect. And as you might expect, when the economy slows down, businesses often have to let some people go. So you get lower overall employment, fewer people with jobs, and an increase in those initial claims for unemployment insurance. Nobody likes to see that. Another big part of the recession picture is a drop in manufacturing activity. The Federal Reserve puts out something called the Industrial Production Report. It's basically a snapshot of how much stuff is being produced in factories, mines, and utilities. If that report shows a decline, it's usually a sign that the economy is cooling down overall. It's also worth mentioning that the NBER looks at these more frequent GDP estimates, even monthly ones. There are firms like macroeconomic advisors who put those together. They give a quicker, though unofficial look at potential economic shifts. Now, here's something that might surprise you. The stock market isn't a perfect real-time indicator of a recession. You might think, well, if a market's down, there must be a recession, right? But it's not that simple. Stock prices are what's called forward-looking. They reflect what investors think will happen with company profits down the road. So the stock market could actually start falling before a recession officially begins. Investors might see a slowdown coming and expect companies to earn less, so they sell their stocks. You've probably heard the term bear market before. That's when the stock market, usually measured by an index like the S&P 500, drops by 20% or more over at least 2 months. While it's not a direct recession indicator, a big drop in the stock market can definitely play a role. When people see their investments go down, the net worth takes a hit, right? They feel less wealthy, and that can lead them to cut back on spending. It all ties together. The point is, a recession isn't just some random event that hits a healthy economy. It's actually a normal, although sometimes difficult, part of a bigger cycle called the economic cycle, or the business cycle. It's like the rhythm of the economy expanding and contracting over time. Our sources break the cycle down into 5 stages. First, you have the recession itself. That's when growth slows down, jobs are lost, and prices are generally pretty stable. Then comes the trough. That's the lowest point the economy reaches. From there, the economy starts to recover and things start looking up. If that recovery keeps going, you get into a period of expansion. That's when growth is strong. Interest rates are usually low, businesses are producing more, and you might start to see some inflation creeping in. Finally, the economy gets a peak. That's the point of maximum growth. But here's the thing. At the peak, things can get out of balance, and that usually leads to a correction, often in the form of, he guessed it, a recession. It's this constant ebb and flow. So what does a recession actually feel like? What are the early warning signs? One of the first things you might see is a decline in manufacturing jobs. Manufacturers often get orders way ahead of time, so if those orders start drying up, they have to cut production. And that means letting workers go. It can create this ripple effect. People lose their jobs, they spend less, and that impacts other parts of the economy. Restaurants get fewer customers, stores sell less, and so on. Businesses see this happening, so they might stop hiring or even lay off more people. And unfortunately, that drives unemployment up even further, which just makes people even more hesitant to spend. In really bad recessions, this whole cycle can lead to businesses going bankrupt and people defaulting on their mortgages. It's a tough time for everyone, especially for new college grads trying to find work. There just aren't as many jobs available. To understand how recessions work and what they can do, it helps to look back at some examples, especially here in the US. Our sources go into detail about some major economic downturns that show how these principles play out in real life. Let's start with the most recent one. The 2020 pandemic recession was really unique. It was triggered by COVID-19, and it hit the economy like a ton of bricks. We saw the biggest contraction since the Great Depression. In April 2020 alone, over 20 million jobs were lost. The unemployment rate went all the way up to 14.7%. The stock market also took a nosedive when the pandemic started. The Federal Reserve had to step in quickly and lower interest rates to almost zero. Congress also put together a huge $3.8 trillion economic relief package. But despite how bad it was at first, the economy bounced back pretty quickly. In the third quarter of 2020, we saw growth of over 33%, which is unbelievable. That made it one of the shortest recessions on record. Now let's go back a bit further to the 2008 Great Recession. This one was much longer. It had a more lasting impact. It started in December 2007 and went all the way to June 2009. It was mainly caused by the subprime mortgage crisis. Basically, a lot of risky home loans were given out, and those were bundled up into these complex financial things called derivatives. You can kind of think of derivatives like insurance policies on mortgages, but they were all interconnected, and that spread the risk all over the financial system. It led to a huge crisis in the banking industry that affected the whole world. In 2008, the U.S. GDP shrank for several quarters, with one quarter dropping by a whopping 8.4%. Unemployment kept going up, and eventually reached 10% in October 2009. It wasn't until the third quarter 2009 that GDP turned positive, and the NBER officially said the recession was over. Let's jump back to 2001. This was the dot-com bubble burst recession. It was a pretty short one, only 8 months, for March to November 2001. We saw the economy shrink by over 1% in both the first and third quarters of that year. This one was mostly caused by the rise and fall of all those internet companies, the dot-coms. There was this huge boom, partly driven by fears about the Y2K bug, and then it all crashed down. And of course, the 9/11 attacks made things even worse. A little further back, we have the 1990-1991 recession. It went from July 1990 to March 1991. This one was caused by a couple of things. First, there was the savings and loan crisis in 1989, which pushed interest rates up and slowed down the economy. Then, Iraq invaded Kuwait, and that created a lot of uncertainty and contributed to the downturn. GDP fell by over 3% in the last quarter of 1990 and almost 2% in the first quarter of 1991. Now, the 1980-1982 recession is interesting because it was actually two recessions back-to-back. The first one was short, from January to June 1980. The second one was longer, from July 1981 to November 1982. A big reason for this period of recession was the Federal Reserve trying to fight inflation by raising interest rates aggressively. Between 1980 and 1982, GDP was negative for 6 out of 12 quarters, and in one quarter it fell by a massive 8%. Unemployment was also really high, over 10% for 10 months in late 1982 and early 1983. On top of that, we had the Iranian oil embargo, which meant less oil for the U.S. and much higher energy prices. It was a tough time. Another big one was the 1973 Nixon OPEC embargo recession. It ran from November 1973 to March 1975. This one was mainly triggered by OPEC's oil embargo, which caused oil prices to skyrocket. Some of President Nixon's policies at the time also played a role. He put in place wage and price controls, but those actually ended up keeping prices high and hurting demand. The wage controls also led some businesses to lay off workers. Then there was Nixon's decision to take the U.S. off the gold standard. That caused the price of gold to go way up, the value of the dollar to go down, and inflation to rise. We saw GDP go down in several quarters between late 1973 and early 1975. Okay, last but not least, we have to talk about the granddaddy of them all, the 1929 Great Depression. Now, it's important to understand that a recession and a depression are not the same thing. A recession is a contraction over a few quarters. A depression is much more severe and lasts for years. Between 1929 and 1938, the U.S. actually went through two big recessions. The first one was the worst, from August 1929 to March 1933. GDP fell by a staggering 12.9%, and unemployment hit a record 24.7%. Unemployment stayed in double digits all the way until 1939. A few things caused the Great Depression. The Federal Reserve raised interest rates in 1928, which didn't help. Then the stock market crashed in 1929, wiping out a lot of people's savings. And then there was the Dust Bowl, a terrible drought in the Midwest that lasted for a decade and devastated agriculture. President Roosevelt's New Deal programs did give the economy a boost in the mid-1930s, and thankfully the drought ended in 1937. He increased government spending in preparation for World War II, also helped pull the U.S. out of this long economic crisis. It's important to remember that recessions aren't just a U.S. thing, they happen all over the world. The International Monetary Fund, or IMF, has its own definition of a global recession. They say it's when the global GDP per capita, adjusted for purchasing purchasing power goes down, along with at least one other global economic indicator. Things like industrial production, trade, capital flows, oil consumption, unemployment, investment, or consumption. Based on that definition, there have only been 4 global recessions since World War II: 1975, 1982, 1991, and 2009. All of those global recessions only last a year, but the 2008 one was the worst in terms of how many countries it affected and how much global GDP per capita fell. So how many of these recessions actually affect us, both as investors and just regular people? Well, when a recession hits, or even when people think one might be coming, investors tend to get more cautious. They might sell off investments that seem risky and put their money into safer things like government bonds. For those who stay in the stock market, they often move towards established, well-known companies with strong financials. Companies that have low debt and a lot of cash on hand. Companies with a lot of debt and not much cash flow can really struggle during a recession. They might have trouble paying your debts and keeping your business going. And one interesting thing is that the consumer staples sector of the stock market tends to do better during recession. These are the companies that make and sell things that people need no matter what's happening in the economy. Things like food, drinks, household products, alcohol, and tobacco. These are what we call non-discretionary items. Things people aren't likely to cut back on, even when money is tight. Remember, you gotta eat, right? And you might be wondering, does anyone actually benefit from a recession? It's a complicated question. There are some people or companies who might be able to make money from economic hardship, like people who bet against the market, or those who can buy up assets at really low prices when others are struggling. But history shows us that it's really hard to consistently predict these things and make money off them. However, on a larger scale, a recession can actually have some positive side effects. For instance, it can help bring down inflation because demand goes down and there's less money circulating. When a recession happens, the Federal Reserve and other central banks often take steps to stimulate the economy. They might lower interest rates, cut taxes, increase spending on social programs, and not worry as much about budget deficits in the short term. A good example of this is the American Recovery and Reinvestment Act, that stimulus package Congress passed in 2009 during the Great Recession. So, to sum it all up, recessions are a normal part of how the economy works, but there's no doubt they can be challenging and cause a lot of hardship. But if we understand what a recession is and what signs to look out for, we can be better prepared. Whether you're an investor or just managing your own finances, there are things you can do to soften the blow. Pay down your debt, avoid risky investments, and be careful with your spending when things are uncertain. Ultimately, understanding how the economy works and having a plan can make a big difference. And as we've seen today, looking back at history can get us some valuable lessons and insights into what might happen in the future. It's always worth thinking about.